Welcome to the deep dive. Today, we're really getting into credit cards. Not just the basics, but digging into how banks operate, the psychology they use.
Exactly. Things that maybe aren't always obvious.
Right. And our goal here is honestly to help you save potentially thousands of dollars, maybe years of debt, just by understanding these hidden aspects.
We're drawing heavily from that article. Credit card traps, what banks don't want you to know.
A really crucial piece.
It is. And we want to pull out the key insights, the things you can use to, well, navigate the system smarter, to stay in control.
Okay, so where's the best place to start peeling back these layers? Maybe the most common misunderstanding.
I think we have to start with the minimum payment. It seems so straightforward, right?
It does. Just pay the small amount, stay in good standing.
But that's where the mechanics really benefit the lender. It's designed, really, to maximize the interest they collect over time.
Okay, explain that. How does that work in practice?
Well, the article gives a pretty stark example. Let's say you have a $5,000 balance.
Yep.
If you only ever make that minimum payment each month,
Yeah.
you can easily be paying that off for like 20 years, maybe even longer.
20 years.
And the total amount you pay back could be double, even triple that original $5,000, all because of the interest piling up.
Because the interest rates are so high, right? Like
Oh.
20, 30% APR.
Exactly, that annual percentage rate. While you're paying that small minimum, the rest of the balance is just accumulating interest at that very high rate. It's a huge profit source for them.
So the advice is always pay more than the minimum. We hear that a lot.
We do.
Yeah.
And it sounds obvious, maybe, if you're already good with finances.
But the impact is bigger than people realize.
Way bigger. Even just an extra, say, $50 a month. It doesn't just chip away at the debt faster.
Yeah.
It drastically cuts down the interest you pay over the life of that debt. We're talking potentially hundreds, maybe thousands saved, and years shaved off.
Right. It's not just paying down principal, it's stopping the interest from working against you.
Precisely. Every extra dollar stops compounding against you.
Okay, that's a big one. What about those offers that seem too good to be true? Like the 0% APR deals.
Ah, yes, the introductory offers. Very tempting.
They really are. 0% interest for a year, 15 months. It sounds like free money almost.
It does sound like that. And look, they can be useful tools, say for a balance transfer or a big purchase you plan to pay off quickly.
But there's always a catch, isn't there?
There usually is. First, that 0% period is strictly limited, 12, 15, maybe 18 months. Then boom, the rate jumps.
To the standard high rate, like 20% plus?
Often, yes. But here's the real kicker.
Yeah.
The part people miss in the fine print.
Okay.
If you miss even one payment during that introductory 0% period,
Uh-oh.
the 0% deal is typically off, instantly revoked.
Wow. Okay, so you just lose the benefit going forward.
Not just that. Some cards have a clause, and this is nasty, where they can apply interest retroactively,
Meaning what?
meaning they go back to day one of the promotional period and charge you all the interest you would have paid if you never had the 0% deal in the first place, on the entire balance for the whole time.
Oof. That could be a huge hit, completely unexpected.
It's a massive penalty. So the actionable point here is crystal clear. If you use these offers, you have to be incredibly disciplined. Set reminders. Set up autopay. Know that exact end date. Don't guess.
You absolutely cannot slip up.
Not even once.
Okay, let's shift gears. Rewards. Points, miles, cash back. Everyone loves rewards.
They do. And again, used wisely, they can provide real value, a bit of cash back, a free flight eventually.
But the article suggests they're also a distraction.
Very much so. It's psychological. Banks know that the promise of getting, say, 1% or 2% back makes people feel better about spending money.
Right, you justify the purchase a little easier. Oh, but I get points.
Exactly. But think about the logic. If you're justifying spending money to get 2% back, but you end up carrying that balance and paying 20% interest on it.
Yeah, the math is way off. You're losing way more than you're gaining.
Precisely. The rewards are a small carrot, distracting you from the much larger stick of high interest rates if you carry a balance.
So it encourages overspending, basically.
It can, absolutely. The key is using rewards strategically, not emotionally. Only spend what you were already going to spend anyway. Don't let the tail wag the dog. Don't spend extra just to get a few points if it means risking debt.
That makes sense. Focus on the big picture, not just the small perk.
Are you controlling your spending, or are the rewards subtly controlling you? That's the question.
Okay, fourth trap. This one sounds painful just from the name. Late payment fees and penalty APRs.
Yeah, this is where things can escalate quickly. Miss one payment due date.
And bam, you get hit with a fee, right? Like $35, $40.
Typically, yes, an immediate fee. but that's often just the start.
What else happens?
The more serious consequence is triggering a penalty APR, which is an even higher interest rate, often jumping up to something like 29.99%, maybe even higher on some cards. And it applies to your entire balance, usually.
Wow. So one slip-up doesn't just cost you a fee, it makes your existing debt way more expensive.
Dramatically more expensive. And getting out of that penalty APR isn't easy.
How do you get back to your normal rate?
It usually requires a period of perfect payment history, like 6 consecutive months of on-time payments, sometimes more, before they might lower it back down.
So it's a deep hole to climb out of.
It really is. It underlines the fact that, banks are businesses, they have rules, and the penalties for breaking them can be severe. They're not really your friend who will give you a pass.
So the practical defense here,
Set up automatic payments. Seriously. Even if it's just for the minimum amount.
just to avoid missing the due date entirely.
Exactly. It prevents that late fee, and crucially, it prevents triggering that devastating penalty APR. It's like a basic safety net.
Build a firewall, basically.
Yeah, automating that minimum payment is a simple, powerful firewall.
Okay, last trap. And maybe the one that enables all the others. The fine print. The stuff nobody reads.
Yes,
Yeah.
those dense agreements. It's amazing how many of us just click agree or sign without looking.
Guilty as charged, probably.
We all are, sometimes. But that's where they bury all the crucial details.
Like what specifically?
Things like variable interest rates, meaning your rate can go up even if you do everything right, based on market conditions, or just the bank's discretion.
Okay.
Obscure fees, maybe an inactivity fee if you don't use the card, foreign transaction fees, balance transfer fees, which we touched on.
Right, the 3% or 5% fee for removing a balance.
Exactly. And of course, the full explicit details on when that intro APR ends, what the penalty APR is, and what triggers it, it's all in there.
You just have to look for those keywords like intro APR ends, penalty APR up to.
You do. You need to actively scan for them.
The article made a great analogy here, didn't it? About a car loan.
It did. It basically said, look, would you ever sign the paperwork for a car loan without reading it? Without knowing the interest rate, the payment schedule, the fees?
No way! Of course not. That's a huge purchase.
Right. So why do we treat credit cards, which can have equally significant long-term financial consequences, any differently? Why sign blindly?
That really puts it in perspective. It's foolish when you think about it that way.
It's about being an informed consumer. Taking that extra 10 minutes to understand the terms before you get the card, not after you're caught in a trap.
Okay, so pulling this all together, it really seems like credit cards are this double-edged sword.
Absolutely. They can be incredibly powerful tools for you building credit, managing cash flow, earning rewards.
Where they can be dangerous traps that lead you into years of expensive debt.
And the difference really just comes down to how you use them. Your knowledge, your discipline.
So being intentional, staying educated about these traps we've talked about, that's the key.
That's the path to mastery. Understanding the minimum payment trap, the 0% APR catches, the reward distractions, the penalties, reading the fine print. If you manage these things, you can absolutely use credit cards to your advantage.
You can build credit, get the perks, smooth out expenses like a pro.
Exactly. You take back the control.
Instead of just sort of letting the banks dictate the terms passively.
Right. So maybe the final thought to leave everyone with is this.
Yeah.
Stop thinking of credit cards as just plastic, or worse, as free money. Start seeing them as serious financial instruments.
Powerful levers like you.
Powerful levers. And ask yourself, are you actively using this tool, or are you letting the potential traps within it dictate your financial future? What concrete step will you take, maybe even today, to make sure you're the one in control?